Welcome back to the Deep Dive. It is Wednesday, January 21st, 2026. This is Talk Tickers, and if you're listening to this, you're probably looking at a portfolio screen that's flashing a very, very specific shade of green.
HAL Halliburton, the big red machine.
Exactly. We are breaking down their Q4 2025 earnings, which dropped this morning. And we have to start with the price action because, I mean, it was aggressive.
It really was.
The stock opened at what, $33? And closed at $33.36. So that's up over 4% on the day. But the volume, that's what caught my eye.
The volume was the tell. We saw about 26.7 million shares trade hands today. And you have to put that in perspective for you. Their 50-day average is like 11.6 million.
So more than double.
Yeah, more than double the normal activity. The big money, the institutions, hedge funds.
Yeah.
They weren't just watching this. They were participating.
And that really sets up our mission for this deep dive. I mean, in this market, a 4% pop on a big oil services name, especially when oil's just kind of chopping sideways, that's not something you ignore. So the question is, why? Was this just a simple beat? Or is there, a narrative shift happening under the surface?
It's definitely the latter. Look, they beat the numbers.
Yeah.
And we'll get to the scorecard in a second.
Yeah.
But if you really listen to the call, I mean, this wasn't about Q4 of last year. This is about framing all of 2026.
They're calling it a rebalancing year.
Which is usually, polite corporate speak for business is going to be slow. Please don't sell our stock. But traders are looking right past that. They're sniffing out two very specific things. One is a potential high beta geopolitical play, Venezuela, and the other, a stealth pivot into power generation.
A stealth power play from an oil services giant. Okay, I like that. So here's our roadmap. We'll hit the results snapshot first, just the headlines, then the deep dive.
Yeah.
We'll break down North America versus international, unpack this whole tech stack thing, and then look at those two wildcards you mentioned, Venezuela and power.
And, of course, we'll wrap up with the This Is Not Financial Advice segment. I've got one I'm calling the Caracas Cloud Arbitrage.
That sounds incredibly dangerous. I love it. Okay, let's get to the numbers first. How did Big Red actually perform in Q4?
Clean. That's the word. It was just a clean execution quarter. GAAP EPS came in at 70 cents. Adjusted was 69 cents. Now, the street was looking for 55 cents.
So a 25% beat on the bottom line. That's significant.
It's massive.
Yeah.
And on the top line, revenue was about $5.7 billion. Consensus was roughly $5.41 billion. So a 5% beat there. But the real story for me was the margins.
Okay.
Adjusted operating margin stood tall at 15%.
And why is 15% the magic number here?
Well, the context is everything, right? The macro backdrop in North America is tepid at best.
Yeah.
So for them to hold a 15% margin in a soft market, it proves they have pricing power, or at least extreme cost discipline.
Got it. And what about cash flow? I know in energy, cash is king.
And Halliburton is listening. They generated $1.2 billion in cash from operations, $875 million in free cash flow, and they are not sitting on it. They returned 85% of their full-year free cash flow to shareholders.
85%? Wow. Yeah. That's aggressive.
Very aggressive. They bought back $250 million in stock in Q4 alone. That's $1 billion for the full year 2025. Plus, they kept the dividend at 17 cents a share.
So the big takeaway here is discipline. They squeezed out margins, handed the cash back.
Exactly. They didn't chase bad work.
Which brings us perfectly to our first theme in the deep dive.
North America, the maximize value strategy. And this is where the story gets a little counterintuitive.
Right, because if you just look at the headline revenue for North America, it looks ugly. Revenue was down 6% year over year in 2025. And the guidance for 2026, another high single-digit decline.
Okay, let me play devil's advocate. Why was anyone cheering today if the company just said its biggest market is going to shrink by almost 10%?
Because in this cycle, revenue is vanity, profit is sanity. Their mantra is maximize value. The CEO, Jeff Miller, he was very clear. They are prioritizing returns over market share.
So they're consciously stacking fleets. They are. And for those not deep in the oil patch, stacking literally means parking the trucks in the yard. If a customer calls and wants to pay a price that doesn't meet their return hurdle,
they just say no.
They say no. They turn off the engine and let a competitor take the low-margin work. They refuse to wear out their equipment for pennies.
That takes some guts when revenue is falling.
It does. But there's a physical reality here, too. Miller mentioned that equipment attrition in the industry is accelerating.
Why now? Why are the trucks breaking down faster?
Because the way we frack is changing. We're seeing fracturing two wells at once and continuous pumping. The equipment is just running harder for longer without brakes. It's grinding the gears.
So the supply of working equipment is naturally tightening.
Precisely. And to offset that lower activity, they're leaning heavily into tech. This is where we have to talk about ZOOCIQ.
Sounds like something from a comic book.
It's their electric fracturing platform.
Yeah.
Adoption was up 18% in the quarter. But here's the killer app. It lets them measure sand placement directly.
And why is that such a big deal?
It's basically the holy grail of fracking. Since, 1947, the model has been pump sand and water down a hole and just hope it goes where the oil is. You've been flying blind.
So ZOOCIQ changes that.
It changes everything. It lets them see the placement, automate the control. And if you can prove to an oil company your tech puts sand in the right spot, which means more oil flows out, they will pay a premium for that.
That's how you keep those 15% margins.
Exactly. But we should note they did warn about Q1 specifically.
Right. Transparency is key.
They guided completion and production margins to drop about 300 basis points in Q1.
That's a steep drop.
It is, but they said it's seasonality winter slowdown and the roll-off of some high-margin tool sales. The market seems to be forgiving it.
Okay, let's pivot to the rest of the world. Theme 2, international resilience. Guidance for 26 is flat to modestly up. Doesn't sound explosive.
It's not explosive, but it's stable. And in energy, stable is investable. But you can't just look at international as one big thing. It's really a tale of two hemispheres.
Here are the winners.
Latin America is the absolute star. Brazil deepwater is firing on all cylinders. Guyana is powering ahead. That's a huge offshore boom. And Argentina, the Vaca Muerta shale, that's becoming a real growth engine.
Vaca Muerta, it feels like the next Permian Basin.
It has that potential. The rock is great. Now, the laggard was the Middle East. They see it as flattish. Management's being very conservative on the timing of, say, a Saudi activity ramp up.
And is the tech story playing out internationally too?
Oh, yeah, it's global. They highlighted StreamStar, which is a wired drill pipe, and LOGIX, their automation unit. And get this, they recently completed the first fully autonomous geosteering run in the Caribbean.
Okay, explain autonomous geosteering like I'm 5.
Imagine you're drilling a hole 3 miles deep, trying to keep the drill bit inside a layer of rock that's maybe only 10 feet thick.
Right.
Normally, a human is steering that with a joystick. Autonomous geosteering means the computer does it. It steers itself.
So it's Tesla autopilot for drill bits?
That's a perfect analogy. And offshore, where a mistake costs millions, that automation is incredibly valuable.
So we have a shrinking but profitable North America and a growing Latin America. Jeff Miller called 2026 a rebalancing year. Let's dig into that. What does he mean?
It's a supply and demand call. He sees OPEC's spare capacity returning. He sees non-OPEC production is up. There's a lot of oil right now. But, and this is the big but, decline rates are steepening.
Because of shale wells.
Yes. They decline so fast you have to keep drilling just to stay flat. His prediction is that supply and demand will rebalance, and when the cycle turns, North America will be the first to recover.
Okay, so the strategy is sit tight, make cash, wait for the turn. But there's a wild card. Well, 2 wild cards. Let's talk theme 3, the stealth power play, Voltagrid.
This is the part I think the market is just starting to wake up to. This is the key insight. Halliburton isn't just pumping oil anymore. They are generating power.
They secured manufacturing for 400 megawatts of modular power systems.
400 megawatts. I mean, that's not a small generator. That's enough to power a small city.
And they're expanding this in the Eastern Hemisphere.
Rapidly. Think about the problem. If you're drilling in the middle of nowhere, there's no power grid. They're using natural gas that would otherwise be flared wasted to generate power on site.
It's cleaner and cheaper.
Right. But the implications go beyond oil.
Yeah.
We are moving into a world where distributed power is critical for grid stability and data centers.
I knew you were going to say data centers.
It sounds buzzwordy, I know, but it's real. Data centers need huge amounts of power. If you have a modular gas-fired power system, you are effectively a mobile utility. And if the market stops viewing them as oil services at 6 times earnings and starts viewing them as power infrastructure at 20 times earnings.
It's a massive re-rating. We'll get to how to trade that. But before we do, investor context. There was one word buzzing all over this call, and it was Venezuela.
The V word, yeah.
Yeah.
Management was unusually vocal about this. They called it Venezuela Reentry optionality.
And they're not new to Venezuela, right?
No, they've been there since 1938.
Yeah.
They know that rock better than anyone. They only pulled back because of sanctions, but they kept a footprint there. Miller said they could scale fairly quickly once everything's resolved.
How big of a deal is this financially?
A decade ago, this was a $500 million a year business for them. $500 million. If sanctions lift, that's high margin revenue that basically falls straight to the bottom line.
A free option. Investors love that.
They do. And that's partly why the stock moved 4% today. People are pricing in that lottery ticket.
Now, to be balanced, it wasn't all good news. We have to mention the operational drag, the SAP implementation.
Necessary evil, yes. They're spending about $45 million a quarter on an SAP S/4HANA migration. That lasts through the end of this year, Q4 2026.
$45 million a quarter is a lot for software.
It's huge. It's basically upgrading the central nervous system of the company. It's painful. It's expensive. They say it'll save them $100 million a year when it's done, but for 2026, it's just a drag.
So we have the headwinds and the tailwinds. Let's look at the market. You said HAL is up 20% in the last month.
Roughly 20%, yeah. Now, compare that to the energy sector proxy, the XLE ETF. That's up only about 8%.
That's a huge divergence.
It tells you everything. The market isn't just buying energy. They're buying the specific Halliburton story. They're buying the discipline and the optionality.
Which brings us perfectly to our favorite segment.
The disclaimer first.
Of course, this is not financial advice. We are not financial advisors. Do not do this at home. This is for entertainment and education. Okay, lay it on me. What's the trade?
I call this the Caracas Cloud Arbitrage.
The Caracas Cloud Arbitrage. I'm already intrigued. Break it down.
Okay, so the pitch is a long position on Halliburton. And here's the twist. We structure it as a pair trade. You go long Hal, and you short a traditional utility ETF or maybe a data center REIT.
Okay, that sounds complicated. Walk me through the logic.
3 reasons. First, the Venezuela kicker. You're buying that recovery for free. It is not fully priced in. If sanctions lift, HAL adds $500 million in revenue that isn't in anyone's model. Pure alpha.
Okay, that makes sense. Reason 2.
The valuation glitch. This is the power story. With 400 megawatts of capacity, Halliburton is accidentally becoming a critical power infrastructure company.
The utility in coveralls.
Exactly. The market values power at like 20 times EBITDA. It values fracking at 6 times.
Ah, I see where you're going. You're betting on the multiple expanding.
Precisely. You want to be long the guy with the 6x multiple who's becoming a 20x company.
Yeah.
And you want to be short the guy who's already priced at 20x the boring utility, but has no growth left.
Is wild. But you know what? It makes sense. It's a bet on the whole story shifting.
It's a bet that an oil services company can reinvent itself.
And that ties it all together. 2026 is a transition. North America is shrinking but profitable. International is stable. But the real potential is in the wild cards, Venezuela and power.
And in the meantime, while you wait for those wild cards, they're paying you a dividend and buying back stock.
Not a bad place to wait. But again, check your own risk tolerance.
And keep a very close eye on that Venezuela news feed. That's the catalyst.
We will be watching it for you. That's all we have for today's deep dive into Halliburton.
Wait, I want to leave you with one final thought.
Go for it.
We just spent 15 minutes talking about an oil company, but we also talked about autonomous robots, cloud-connected sensors, electric power generation, and a software migration.
It doesn't sound like the oil patch of 1947.
It's not. And that's the provocation. If an oil services company starts generating gigawatts of power and running autonomous bots, are they still an oil services company? Or are they a tech utility wearing coveralls?
I think we know the answer. If you enjoyed this breakdown, make sure you're subscribed to Talk Ticker so you don't miss the next earnings deep dive. We'll be back with another ticker soon.
Talk Ticker signing off.
See you next time.